Good morning, student. How are you today? I feel fine well. So, today we are going to learn about the international monetary system. The topics that we will study today is about what is the international monetary system, what was the gold standard, why did the gold standard make sense, what was the Bretton Woods system, what institutions were established at Bretton Woods, why did the fixed exchange rate system collapse, what was the Jamaica Agreement. So maybe Jamaica Agreement you can study by yourself. You can learn by yourself. And then what happened to exchange rate since 1973. And then what type of exchange rate system in practice today. What is peg rate system? What is currency board? What is the role of the IMF today? So I think you can read by yourself. And then the last one, I will talk with you about what was the Asian currency crisis and how has the IMF done. And lastly, what does the monetary system mean for a manager? So let's start with the next slide. Did you know that there are international agreements that govern exchange rates? In this chapter, we're going to talk about the international monetary system, how it evolved, and where the exchange system that in place today came from. We'll also explore some of the implications of the system for international business. First, let's go over some definition. The international monetary system refers to the institutional arrangement that countries adopt to govern exchange rates. A floating exchange rate system exists when the foreign exchange rate market or supply and demand determine the relative values of currency. This is a type system used in the US, in the European Union, Japan, and Great Britain. When the value of currency is determined by market force, but the central bank intervenes if it depreciates too rapidly against an important reference currency. Dirty floats exist. China has used type of system since 2005. The yuan is allowed to float against basket currencies that include the dollar, the euro, and the yen, but only within very tight limits. Countries that adopt a fixed exchange rate system fix the values of the currency against each other. Prior to the introduction of the euro, some EU countries operated under fixed exchange rate within the context of the European monetary system. A pegged exchange rate system exists when the value of currency is fixed to reference country and the exchange rate between that currency and other currency is determined by the reference currency exchange rates. As you might recall from the opening case, Latvia had peg system exchange rates. You know Latvia, right? One of the country in Europa and Europe, I mean. Why are there so many different types of exchange rate system? Well, to understand the current international monetary system, we have to go back to the 1930s and the time of gold standard to see the evolution of today's system. The origin of the gold standard dates back to the ancient times when gold coins were the medium of exchange. When there is little international trade, international transactions were made in gold or silver. But after the Industrial Revolution, a new system was needed, and the gold standard was established. Under the gold standard, its currency was linked to a fixed amount of gold. The dollar, for example, was equal to 23.22 grains of fine gold. The exchange rate between currency then was based on the gold var value, or the amount of currency needed to purchase 1 ounce of gold. In other words, if you had dollar and need franc, you will convert your dollar to gold and the rate 23.22 grains of gold per dollar, and then convert that gold to francs at the francs or a good rate. So why did the gold standard make sense? The gold standard was effective because it had a powerful mechanism for simultaneously achieving balance of trade equilibrium for all countries. A country has balance of trade equilibrium when the income a country's resident earn from its export is equal to the money its resident pay for the import. What does it mean? Well, if Japan has trade surplus with the US or export more to the US than import, we see dollar flowing out of the US. To pay for the import, after the Japanese exporter cash the dollar in for yen at the Japanese bank will trade them for gold with the US. The outflow of gold from the US will reduce the US money supply and increase Japanese money supply, causing higher price in Japan and lower price in the US. So, demand for Japanese good will drop, while demand for American product will rise, and balance of payment equilibrium will achieve. The gold standard was followed from 1870s until the start of World War I when it was abandoned. By the end of the war 1918, prices were higher everywhere because countries had printed money to finance their war expenditure. Again, recall the relationship between the money supply and inflation we have talked about in chapter 9. Then, in effort to encourage export and domestic employment, countries started to devalue their currencies. Recall that if country currency is worth less, import will be more expensive and export will be cheaper. People began to lose confidence in the system and started to demand gold for the currency, putting pressure on countries' gold reserve and forcing them to suspend convertibility. By the start of the World War II in 1939, the gold standard had been abandoned. So in this slide, we'll talk about what was the Bretton Woods system. New international monetary system was established in 1944. Representatives from 44 countries met at Bretton Woods. Bretton Woods is New Hampshire with the goal of building an enduring economic order that would facilitate post-war economic growth. Under the Bretton Woods system, the only currency that was to be convertible to gold was the dollar. Other countries set their exchange rate relative to dollar. So, the dollar was set against gold $35 per ounce, and that each country determined its exchange rate relative to the dollar. The devaluation were not allowed for competitive purpose, and country couldn't devalue its currency by more than 10% without IMF approval. As part of the Bretton Woods Agreement, the two multinational institutions were established. The first is IMF, or that we call International Monetary Fund, was designed to maintain order in international monetary system, and the goal of the second, as at the World Bank, was to promote general economic development. So why was the IMF very important? The IMF, using combination of flexibility and discipline, was responsible for executing the main objective of the Bretton Woods Agreement, with the goal and avoiding the chaos that occurred during the time between the wars. Let's talk a bit more about discipline imposed by the IMF. The fixed exchange rate system provides discipline in two ways. First, the need to maintain a fixed exchange rate limits competitive devaluation and bring stability to the world trade environment. Second, because the system imposed monetary discipline on countries, inflation is limited. So fixed exchange rates help control inflation and force economic discipline in countries. Why was flexibility important? Well, representatives at the meeting recognized that the rigid policy of fixed exchange rates would be too inflexible in a more global world. So instead, the IMF created a fund using contribution from members that give it the ability to lend foreign currencies to members to tide them over during short-term balance of payment deficit when implementing a rapid tightening of monetary or fiscal policy will harm the domestic employment situation. So, and next slide is about what institutions were established. World Bank. So what was the purpose of the World Bank? The World Bank, or it's officially known the International Bank for Reconstruction and Development, was initially designed to lend money to help rebuild Europe, but shifted its role to helping this world nation after the Marshall Plan was implemented. The World Bank makes loan in two ways. The first methods involve raising money through bond sales in the international capital market. Borrowers pay a market rate of interest is calculated based on the bank cost plus expense. The second method, which is overseen by International Development Agency, raise money through subscription from wealthy members like the US. This loan only go to the very poor countries which have 15 years to repay at a 1% per year rate of interest. So I think for the next slide, yourself. So why did the fixed exchange rate system collapse? Why what happened to exchange rate system 73? A little bit in the last slides. What was the Asian currency crisis? As we know that we are having crisis in 1997, 1998. So you can this about history. Thank you very much. Thank you for listening to me. Have a good day.